Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. Much as Chicago and Kansas City wheat, this market is a story of three patterns, though not necessarily channels and also not necessarily of the same results. I'll explain. The first pattern, and the largest, is the late June to early September bear channel that morphed into a descending wedge pattern. Then there is the early September to mid-October rising expanding wedge pattern. And finally the most recent and shortest pattern is the mid-October to mid-November bear channel that together with the expanding wedge pattern made a V-top pattern. Now 2 weeks ago prices broke higher outside the bear channel, rising as far as the combination of short medium moving average currently at 231 and the recent March to May 50% Fibonacci line also at 231 when they were capped and gapped lower. However, the move back down has not exceeded the low when the market was back in the bear channel. Interesting point there. Both being stopped by the 50% absolute Fibonacci line below at 219. That's a level to watch. All this has left behind potential targets below for the early September mid-October rising expanding wedge pattern. A primary target in the 217, a target X in the 217 zone, and a secondary harder to reach target X1 down at 208. Interestingly, I said 3 weeks ago, and I quote, I suspect the best supports for this market are from where we are now down to the 50% absolute Fibonacci line at 219, and it might well be easier to reach target X and target X1 should prices manage to drop below the 50% absolute Fibonacci line. We'll see if this comes about should prices venture that far down. End of quote. Well, whilst my thoughts about the 50% absolute Fibonacci line and supports above it turned out to be true, but I'm also beginning to wonder just how much bullish incentive there is now in this market, as prices are having issues at the short medium moving average and the 50% Fibonacci combination. Plus further overhead there are some significant resistances, specifically the neckline extension to the June to November 2023 head and shoulders top, currently at 237, and the 238 to 247 congestion area containing the March 2013 high at 240 and the February 2013 high at 247. Plus we have a newer October based congestion between approximately 237 to 245, so it's a little bit narrower within that was caused by the previously mentioned congestion band. Additionally, there are two other patterns you should take note of. The first is the previously mentioned bow tie formation made 2 weeks ago from the short moving average, currently at 225, the medium moving average, currently 227, and the long moving average, currently 229. The moving averages went into and out of the bow tie in the right order, but whilst the way in looked a clean move lower, the way out has been messy and even starting to look higher. I'm reserving my judgment on that part, but I suggest that approximately 15 to 20 sessions after the crossover look to see some volatility in prices and maybe direction. So watch out between the 16th to the 20th of December to be sure. Secondly, I've drawn a new late May to mid-October bearish shift pitchfork. The main thing to watch out for here is the upper tie, currently at 232, which may provide another level of resistance overhead. Minneapolis wheat. The market here is and has been a little different when compared to Chicago, Kansas City, and even Paris wheat. You see, for many months now, the core recent pattern is a very large one, a sideways expanding wedge pattern, highlighted in dark blue on my daily chart, and that's currently 549 to 700. This pattern is still alive, though not without incident, and there is also a much larger pattern as well, when I've been discussing in my commentaries here for months, and that's a descending expanding wedge pattern, currently 638 down to well off the bottom of my daily chart. The upper trend line has been escorted and reinforced since at least last year, though not very well, I have to say, by the declining long moving average, currently at 645. I've kept this breached, large, original descending wedge pattern still on my daily chart, as the others that were here, originating from August, September and October 2023 through to April 2024, have all been thoroughly broken, and this, the largest one, is still here even if it has been previously breached as a just in case situation. Going back to the market action, prices turned higher from a small V bottom in late August, prompted by the breached purple highlighted September 2019 today uptrend, currently at 5.99, into an early September to mid-October scrappy looking ascending expanding wedge pattern. Unsurprisingly, this peaked in mid-October and was capped by the combined upper trend line of the expanding wedge pattern that was also the neckline to the inverted February to June head and shoulders pattern, thus turning lower and creating a bright red October to date based bear channel, currently 5.49 to 5.93. This turn lower did not quite have the integrity here for a V-top as seen in other weak markets, but the bear channel, despite some other grain markets heading higher, has maintained its integrity till at least yesterday and possibly maybe or maybe not today. 3 weeks ago and then again last week and this week, prices moved below the breached purple September 2019 today uptrend, but have had issues in stabilizing below it. This has left the secondary harder to reach target X1 for the September to October based small ascending expanding wedge pattern down at 5.63 at the low of August, hanging out there a little on its own. The primary target for this pattern had already been achieved, so that's been done. It's just a harder to reach secondary target. Additionally, prices are now testing and breaching that upper bear channel line of the bright red October to date based bear channel. It was, as I said 2 weeks ago, and I quote, "We are seeing the market getting squeezed like a toothpaste tube in between the overhead bright bear channel line and the purple neckline. Something is going to have to give way and it will be soon," end of quote. And it has. Well, I thought it might be the upper purple uptrend, but it might be the purple uptrend, but it is increasingly looking like it might be the bright red upper bear channel line. Not only that, as today I drew a late May to mid-October bearish Andrews pitch hook, and the market is also now trying to breach the upper time there, which is currently also at 5.93. What is interesting about this upper time is that it is in lockstep with the bright red upper bear channel line. One would have thought such doubling up of bearish pressures would have a stronger result, but apparently not. At least, if by my next commentary we end up where we are, just underneath the upper time, I can finesse this pitchfork to a shallower bearish shift pitchfork with the same move. But it might be the end of the bright red bear channel, so watch this space and also that target on the downside. London UK feed wheat. This is not going to be a very long commentary, but there is only now one major significant pattern on this daily chart, and that is the bright red late May early July bearish shift pitchfork. The market is right now in between the overhead upper time, currently at 187.10, and the middle time below, currently at 151.5. Despite other mainly bearish patterns, this bright red one has been gently maneuvering prices lower since early July. Additional to this, we have overhead all the moving averages, the long moving average currently at 180.55, entwined right now around the overhead 50% absolute Fibonacci line at 180.5. We then also have the September 2021 low overhead at 181.70 plus the flatlining short medium moving average currently at 182.20 and the slowly declining medium moving average currently 184.25, a little further higher. Below, well, we have the recent March to May 50% Fibonacci line at 178.25, but there's not much until the November and late August lows at 174 and 174.65 respectively. This leaves what I said 2 weeks ago still in the frame, and I quote, "So, looking at the early October actions, what may turn out to be the key feature was the island top over early to middle of October for potential target X below in the 169.90 zone. This island top led to the October to mid-November bear channel, which we exited out of the top, though not necessarily that convincingly. I voiced some doubts about the bear channel the last few weeks, but I have also said I would go with it until something better comes along. I'm now looking for that better move or pattern to appear." End of quote. I'm still looking for a better pattern to appear, but until then I'll utilize this bright red bearish pitchfork as the pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.